where we will be introducing you to the agriculture, forestry, and other land use sector guidance today. This is under the Climate Bond Standard program here at Climate Bonds Initiative. My name is Justine Leigh-Bell, and I head the Climate Bond Standard program at CBI. So joining us today is Hans Biemans, Head of Sustainability for Global Financial Markets at Rabobank, who will share with us his outlook on the green bonds market and opportunities for the AFOLU sectors. I also have with us today Tanja Havemann, Lead Specialist in the development of the Agriculture, Forest, and Land Use Sector Guidance and CEO of Clarmondial, based out of Zurich. She will be taking us through the key features of the AFOLU guidance later in the presentation. But before we begin, I'd like to first go over some basic housekeeping items. The webinar is going to go for about 1 hour. Your audio is muted. We will have a dedicated Q&A session at the end of the presentation. You can submit questions by using the Q&A panel on the right hand of the screen in the webinar platform, which we will come to at the end. You can also raise your hand using the hand icon at the bottom of the attendees list, so our host will unmute you. Please note you can also make the presentation full screen by pressing the full screen button on the top right of the slides. This webinar is being recorded and will be made available to participants after the webinar. And of course, if you are experiencing any technical problems, please do contact the host using the chat box. All right, so how we'll go ahead and structure this webinar today is I'm going to start by giving a high-level overview of the green bond market and how that relates to the climate bond standards, and give you a run-through of how that all works. And then I'm going to turn it over to Tanya, who will then go through the specifics of the AFOLU standard, which is currently out for public consultation. And then we will turn it over to Hans Biemans from Rabobank, where he will give us a rundown on his perspective of the market and opportunities for the sectors. Okay, so for some of you, this is quite not new information. You're fully aware of what's going on in the green bonds market. For others, you're hearing this for the first time. So I think it's always good to give a sense of what is actually happening and what all the excitement's about. The drive behind this market really is coming from the institutional investor base. There's clearly no shortage of capital. We're looking at roughly about 80 to 90 trillion assets under management, and the key drivers creating demand in the market is large institutional investors who have clearly identified the risks in the long term that climate change poses to their portfolios, and so therefore are looking for green product that they can start to move into their portfolios and start de-risking over time. And so essentially that's really where we saw the beginning of this market, potentially mainly coming out of the Nordic region, looking to the development banks to give them something that they could invest in. And so there began our green bonds market in the early part of 2007, 2008. To give you a snapshot of the rapid growth that we have seen in the last couple of years, really taking off in 2013, in the early part of 2013, where we had IFC issuing a benchmark issuance of 1 billion euros tied to renewable energy portfolios. And from this really created an excitement into the market, particularly with corporates, where they saw that this was an opportunity. Investors were buying. In fact, that particular issuance, I think, sold out in a 2-hour window, and from that, towards the end of 2013, corporates started to come into play. By the end of 2013, we were around 11 billion. By 2014, we hit close to 40 billion. And so from that, we started to have new players come to market. Of course, the banks started to play quite a major role, private sector banks, a number of corporates, and then of course we started to see the development of the green bond muni market out of the U.S., which continues to contribute to much of the numbers that we see today. Growth continues to grow, and of course in lead up to COP we suspect that we will see quite a bit coming out. Again, diversifying across the different types of issuers, and of course investors are most definitely paying attention. The market has become so successful that there's not enough supply to meet demand. And so for those of you hearing this for the first time, important to sort of go through the basics, really essentially what is a green bond. The beauty of the green bond is that it is no different from any regular vanilla bond. What investors are getting is the same risk-reward profile that they would get with any other bond, except for by going green, they're getting that additional green feature to the bond. Again, comparable pricing, and mainly following the refi model. So essentially what we're looking at is a lot of repackaging of existing assets that then allows to free up capital on banks' loans books to be able to start looking at more project finance. A lot of this is 90% investment grade, so we are still seeing high quality product coming from blue chip issuers, but by no means does it mean that there's not opportunity to be had for those of you that are not at that level of credit, but it is definitely an opportunity to be had. Again, a number of different entities that are issuing, and then of course key feature really is around the transparency around what the investor is getting. So clear transparency around use of proceeds, the management of those proceeds, reporting on those proceeds, and clearly towards projects and assets that are delivering on a green agenda, specifically climate change. Independent review is being done to provide this transparency, and so this is something that investors are really attracted to with these products. Benefits to the issuer really is two key essential things. They are diversifying across their investor base. Most are picking up new investors every time they're issuing, and then of course there's a huge reputational benefit that comes with this, and then of course the ability to pull in a number of different assets across portfolios, and of course we've also seen that investors have been staying loyal to the issuer, so coming back and investing again on repeat issuance. And so this is just to give you a snapshot of where most of the issuance has been falling across within the different sectors. This is just pulled from our State of the Market report that we do every year with HSBC. This is coming from the July 2015 issue that we put out, and you can have access to this online on our website. But again, just to give you a sense of where the shares fall, again, energy continues to dominate, particularly around the renewable energy base. But then, of course, we have also seen growth coming through on the energy efficiency within the built environment. So quite a lot of green property portfolios that we've been seeing. Again, not to be discouraged by the fact that a very small share is being fallen on the agriculture and forestry sectors. We expect this to grow, particularly once there's more awareness on where the opportunities actually lie in these sectors. Given how young the market is, the growth of standards and being able to educate the market on what's possible, we strongly believe that number will grow over time. Other areas, of course, water and transport. I've seen quite a bit of issuance in that this year, and expect that to be a huge growth area moving forward. And so how are people coming to market issuing green bonds? I said, lots of questions about how and how this all works and the costs and so on and so forth. And so important to highlight that one of the, great developments that we've seen for the most part is that you are getting an independent review being done, essentially what is being coined as the second opinion model, where an independent body like a sustainability rating agency, which some of them you can see here, Vigeo, Occam, or DNVGL or auditing firm, will come in and review the portfolio and write in a report to that end, highlighting what the key features are of the bond and what the management around those proceeds are going to be over the term of the bond, and of course the commitment to annual reporting. And so essentially this is what the investor is getting to be able to get a sense of what is being offered and determine whether they're going to invest in it or not. They may continue to do it further due diligence before investing, but essentially what we have seen in the early start of this market with the development of the green bond principles is transparency is important, reporting is key, and of course this is not about the credentials of the issuer as much as it is the assets, the fact that those are green assets and that they are delivering on an impact. But of course this process can be quite bespoke, and costs vary depending on which independent reviewer you're using. And we've also seen quite a bit of variability across the different types of opinions being provided, and consistency hasn't always been there. So I think one of the key drivers for us in developing the standards is to be able to reach that level of scale that we actually need to see moving forward. We've got the opportunity to be meeting the significant costs required for infrastructure development that is needed globally. We are looking at $1 trillion of assets needed annually up to 2030 to be able to do this. And so with the use of standards, you have the ability to reach that scale. You have consistency, credibility, and the consistency is pretty key, and to be able to have comparison is pretty essential. So also transaction costs and trying to keep those as low as possible without compromising on the robustness, and that's very, very, very much key to developing the standards. Just quickly to give you a sense of opportunity here, what we've been talking about very much lies within the dark green circle. This is the self-labeled market that has now been escalating over the last couple of years. But the report that we also do tends to also want to highlight that the unlabeled market, so this is where bonds are tied to assets and projects that clearly meet a climate change agenda, but are not coming to market labeling themselves as so. A lot of these are repeat issuers. So for instance, these are rail bonds, solar bonds, wind bonds. Again, coming from a $65 billion outstanding market, we're now looking at an opportunity of $600 billion outstanding. So again, with the use of standards, development of those, and education of the market, we can start to tap where those opportunities are within that larger space. And so just quickly, conscious of time, I think, again, how does this all work in terms of, okay, we have this agriculture, forestry, and land use guidance, and we've got this overall climate bond standard and certification scheme. How does it all fit together? And so the organizational structure very much lies on having a overarching climate bond standard board. These guys are worth roughly about 35 trillion of assets under management, and they really are essential to the standards program in that they are there to make all decisions related to the standards, and of course to any of the certifications that they review and approve. These consist of all different types of market folks, stakeholders. Essentially institutional investors are key to this, and so we've got groups like CalSTRS and the Institutional Investors Group on Climate Change, and we've got NGOs like NRDC and CDP, California State Treasury, and of course Insurance Mutual Fund Association. So quite a different groups of representation there, but again, quite key to the standards program in that they support all that comes out of it, and particularly certification, signaling to the market that this is a good product that the investors should invest in. Technical working groups are there to essentially develop the proposals and the standards, headed by a lead specialist, Tanja Havemann being one of those of ours today, and of course the industry working groups that are running along parallel to these technical working groups. These are potential issuers, banks, some government entities that review the proposals and advise on the practicality of what the technical working groups are developing. And then, of course, the Client Bonds Initiative is there to manage and coordinate the process. A number of different areas that we look at. Agriculture, forestry, and land use is only one of those. We also look at water, low carbon transport, energy efficiency, and so on. So there's quite a different number of areas that we look at, and of course everything is looking at the latest scientific evidence base on a two-degree trajectory within the climate change. Just to give you a sense of who's all involved, quite a number of different organizations. This is just a snapshot. At least 80 plus organizations involved, and it's quite a mix. It's international organizations, it's NGOs, it's academics, all there to feed into the development of this work based on their experience and expertise that they feed into the development process. And so this is essentially the overarching Climate Bond Standard framework, which consists of 3 different parts. Part A is our general requirements, so all bonds that are adhering to the Climate Bond Standard will meet these requirements, essentially around mainly around the management of the proceeds and transparency around that end. Of course, Part B is then quite specific to the different types of projects and assets that are included in the portfolio. And so there you can see that the number of areas that we look at will have specific criteria depending on types of assets and projects. And then Part C is for different types of bonds, whether you're talking about general use of proceeds bond, project bond, muni bond, there might be some specific criteria to look out for in that respect. Those issuers that are adhering to the Climate Bond Standard are looking for certification, so this feeds into the certification scheme. So how does that work? So a bond issuer would come to us and say that they were interested in certifying their bond, their portfolio. So we would then direct them to one of our approved verifiers under the scheme. We have quite a few of those, in particular KPMG, EY, DNVGL, and then of course some of the sustainability rating agencies like Occam, Sustainalytics, and Vigeo. We've also, the verifier then looks at the portfolio, does a review against the standard, makes sure that the issuer is meeting those requirements, provides the evidence to that end into a assurance report. That assurance report comes to us, we send it off to the board for a review, the board reviews, and then that is stamped for approval. The costs are tied to the verifiers, so whatever the verifier will be charging for the service, the issuer decides which verifier provides them with the service they are looking for the cost that they are willing to engage with. And then, of course, from our end, it is 1/10 basis point of the bond issue for the certification fee. So just to give you a sense of where the costs lie. And then, of course, the process itself, it really depends on where the issuer is in terms of how well set up they are in terms of their internal processes. But for the review on the Climate Bond Standard side, it's quite a short window of time depending on what we're reviewing. So that puts me to stop and to turn it over now to Tanja Havemann. Again, Tanya Hoffman is our lead specialist who's been driving this work forward. She's done a fantastic job to get us to this stage. She's also the CEO of Clarmondial, which is an investment boutique on impact investments out of Zurich, and she's also, Clarmondial is a partner organization to the Biemans initiative. So we're very fortunate to have her with us today. Let me turn it over to you, Tanya.
Thank you. How do I switch over to the next set of slides?
Tanya, if you click on the tab that's just to the right of the green button, one that says Clarmondial.
Sorry, Tanya, can you see the little area that's sitting right at the top of the... I can switch it if you need me to.
Yes, that would be great. Thank you.
Okay. Can you see that?
Yeah, I think we can just go to the next one.
Okay, can you see that?
Yeah, perfect. Thank you. All right. Thanks, everyone, for joining us for this webinar. I'm sure I don't need to go into much detail around why these are such important sectors. Obviously, together they contribute over 25% of global greenhouse gas emissions, so that's more than the transport sector. And crucially, they also are one of the main sectors that can be a carbon source as well as a carbon sink. And this ability for agriculture and land use sectors to sequester carbon and be a source of nutrients and food and other ecosystem services is obviously being impacted hugely by climate change already and will continue to do so in the future. So we're already seeing things like changes in protein of several key crops like wheat. And at the same time, we're seeing an increased stress on these systems due to just simply population increases and changes in diet around protein consumption. So these are obviously hugely important sectors to consider in the context of climate change for mitigation, adaptation, and also for resilience. So let me see if I can switch to the next slide. All right. So the first question I always get asked is what might some hypothetical examples or some opportunities be? I've listed down a number of potential examples. The companies that we have in the last column, many of them have been involved in this working group already, and we've had discussions with several government departments as well as several large corporates around these types of standards already. So they can include things like reforestation, processing, energy efficiency, storage infrastructure, and what's important to just reemphasize that Justine mentioned earlier is that there can be sort of a different mix of different interventions within a bond portfolio, and it's not necessarily at the corporate as such, it's more about what is packaged into the bond. In terms of this particular guidance, obviously we're dealing with a huge number of sectors, and there is a lot of diversity within them. Typically, the agriculture, forest, and other land use sectors, there's been more complexity around what green actually is because you're dealing with so many different issues, and also it doesn't seem to be as straightforward as renewable energy or energy efficiency. So these standards should, or this guidance should really be considered as a first step towards increasing transparency within these types of bonds from these sectors and trying to promote greater consistency and a scientific base around reporting and monitoring. So for this reason, we will probably also be reviewing this set of guidance on an annual basis. And I think the key point here is to really encourage more consistent reporting using scientific principles and inputs, and more transparency. And it's also important to note that I think any sort of CBI accreditation that's given will not be retroactively removed. So we're hoping that we're starting with a relatively inclusive starting point, which we can then build a good information base to potentially differentiate on over time. We were quite fortunate to have a lot of interest, both from very well-known technical institutions, such as USDA, which is the U.S. Department of Agriculture, ICRAF, which is the World Agroforestry Center based in Kenya, WWF, and various technical universities and research institutions from around the world. We were also very fortunate to have a lot of industry interest, and here it's also important to note that the technical working group really were the ones that drove forward the guidance, and that was tested periodically against the industry working group for its practicality, and if it's something that they really think that realistically they could make a use of. However, the technical working group had the final say in terms of what the outcomes were, and I think we felt very fortunate that we had a very sort of proactive and engaged group. In terms of the outcomes, so if you've been on the CBI website and looked at the standards, you'll see that there's a very long technical document accompanied by a shorter industry working group document. The technical working group document really provides a repository for some of the credible scientific sources for these sectors, and we hope that people will use those very much as a guide, and also a very detailed explanation of why different sets of guidance were set, and what we see in terms of pressures on these different sectors and outlook. And the industry working group is more of a shorter snapshot, which is intended for businesses and industry and corporates who are interested in the space. As a next step, we will very likely be looking into more detail in specific subsectors, for example, marine-related assets, because we recognize this is a very sort of broad set of guidance. And we estimate that the final guidance documents will be ready for early December, just in time for COP. So in terms of the guidance document, the main points are that all types of investments are eligible, and the main thing that we're looking for is net positive greenhouse gas mitigation impact within the timeline. So that means either at the start or 50% compliance at the start, with a credible plan to achieve that within 3 years. And that greenhouse gas mitigation target is against a baseline that is credible and that is comparable, that looks at sort of the standard practices within an industry or a geography. We will look at adaptation resilience claims, in particular where the net mitigation target is lower, and we will be seeing if people reference things like national adaptation program plans. However, the main focus is on the mitigation target, at least for now. And though we encourage use of best practice social and environmental standards, I think we had to recognize that these are not greenhouse gas mitigation standards, and so they are important, and we would consider that those are important things to consider within the issuance, but they are not critical to if you get the certification or not. So the eligibility criteria are listed below. So as I said before, these make reference to a clear greenhouse gas emissions baseline and estimated impact. And in the technical working group document, we have provided sources for both information like the emissions factor databases and different national sources or regional sources that we would expect to see referenced within any such documentation and calculations. Finally, I'll leave you with some more hypothetical examples, and happy to take any questions about this or the longer documents that are on the website, should that be of interest. Thank you.
Thank you, Tanya. So now what I'd like to do, if we could just switch it over, that would be great. So now let me just introduce you to Hans Biemans. Again, we're quite fortunate to have him with us today. Again, Head of Sustainability for Global Financial Markets at Rabobank, and very much involved in this work and supporter of this work, as we did have Rabobank active in the Industry Working Group. And so very poignant to have him with us today to get his perspective on this market and where the opportunities lie. Over to you, Hans.
Thank you for the introduction, Justine. Yes, I have been working on this standard, and one of the reasons is that Rabobank is a large food and ag bank worldwide. We are active in some 44 countries, and we have a lot of wholesale clients in food and agri. So I was very much involved in this new standard, and also very interested, because I do think that the food and agri sector as a whole can really contribute to a lower carbon footprint. One important remark I want to make in advance, and that is that the food and agri sector is a sector with a lot of small companies. So we do have a number of bond issuers, but on the other hand, we also have a lot of privately owned, not listed companies, not per se small companies, but not listed, not stock listed. So it's a challenge for investors to invest in these companies. Sometimes, let's say, the returns are also low. It's a competitive sector in terms of banking them. So I think the standard cannot only be used for let's say bonds, but maybe also for private placements and other forms like ABSs. The next remark would be it's also a very broad sector. So if I look at the kind of companies, of course you have the typical soft commodity traders and producers like coffee producers, cocoa producers and traders and so on, but also fishing. You have food manufacturing, you have beverage companies, you have food retailers, so supermarkets, farm inputs companies that make fertilizers or protection products, crop protection products. We have restaurants, of course, also fast food restaurants. We have biofuels, and of course forestry. And then we also have companies who are active in the chains, like for example chemistry companies who are active in biochemistry, for example, who produce bioplastics with fibers. So the circular economy chain, but also paper and packaging sectors. So we are looking at a very broad sector, and that made it difficult to make, let's say, a good standard that fits all. On the other hand, it's important, I think, for the green bond market as a whole that we get some examples of how things can be done. So I think the standard as we have it now as a draft is quite, let's say, flexible and broad. So hopefully companies can, let's say, fill that in and give us examples of how a green bond can be structured. I wanted to give with my slide a few examples of how this could look in a broad sense. And I think I will focus on three types of companies with the examples: the soft commodity traders, the food retailers, and the food manufacturers. But I will use the slide as a basis. If you look at the slide, you see three large categories. First are the assets with a reduced climate footprint. That is more or less the classical category that could also partly be applicable for other sectors, totally not agricultural sectors. The first category is green buildings, so factories, warehouses, wastewater treatment, etc. So that's, let's say, green efficient buildings. The second dot is investment in sustainable managed land assets like plantations and forests, and water assets. Of course, it must be determined what exactly the criteria are for a sustainable managed plantation and a sustainable managed forest. But let's say very simple criteria could, for example, be a palm oil plantation that is RSPO certified or a forest that is FSC certified. Same is for water assets. It's a bit more difficult, and usually there will not, let's say, be a lot of money in fishing rights, but there you could, let's say, expand with FSC or MSC certified vessels and that kind of equipment. That's the last part, the green equipment, like transport vehicles, fishing vessels, machinery, and so on. So that's, I would say, the classical climate footprint reduction category. The second is more challenging. Total expenses to produce a certain sustainable product. If you look at the food retailer, for example, they usually have 3 different sustainability teams. The first one is environmental. That would mean the energy infrastructure. That's the first category, assets with reduced climate footprint. The second is food security. The second for food retailers is a team which is more or less related to health. Health is both a social team and an environmental team. So the healthy, let's say, the healthy relevance of the climate relevance of the health team lies in the fact that if people have healthier diets, it usually means less meat and less sugar. People with healthy diets switch to other sources of animal proteins like fish and insects, but also more vegetables. So these diets are likely to have a lower carbon footprint. It's a bit, let's say, a bit more far away from our normal, let's say, climate assets. But I think the health team of food retailers would also potentially be part of this standard. And then the third team of food retailers is responsible supply chains. They work very hard usually on making sure that all their products, which contain a lot of raw materials, are responsibly sourced. But if you go back then to the slide, then the second category, total expenses to produce a certain sustainable product, means, for example, for a retailer, that they would look at the total sales formula expenses for these products, and that would also be the case for a food manufacturer. So what is often the problem in food and agricultural companies is that the expenses, the strictly green, let's say, infrastructure examples as we gave above with the buildings, the amounts are limited. So if you take, for example, a food producer, they might have a windmill next to the factory. They will have water efficient equipment. They will have heat pumps to reduce heat use, etc. But all those investments in individual equipment or machinery will only cost, let's say, 1 or 2 million. So that means a treasurer can never ever issue a 500 million green bonds if he would only look at such, let's say, tiny equipment investments. So it means that you have to look much broader. You have to look at the expenses of the whole factory to make that work for the first category. For the second category, you could also reverse things, and you could say, well, we make products sustainable, and sustainable products have a lower carbon footprint. So we do not, let's say, look at how we produce it in terms of buildings, factories, but we look at the product itself, and we look at all the, let's say, costs that we make to make this sustainable product. So that means all the investments and expenses in raw materials, in packaging, in labeling, in sustainable certification schemes, but also advertising and supplier standards. And that sounds a bit strange, but if you talk to a treasurer in this area, they usually do not know how much money they spend on individual equipment like fridges or vehicles or factories, but they do know how much they spend on a product. And they do know that in quite some detail, so including things like raw material use, packaging, labeling, etc. So they know the entire costs of a product, and probably they also know how much profits these projects generate. So from a treasury perspective, it's important that the standard meets, let's say, their requirements in terms of what kind of amounts can they come up with. So if they cannot come up with, let's say, small amounts that let's say are very dark green, but would never add up to a green bond, that would not help. So you need a more broad approach where you say either you take all the sales formula expenses for certain products, including investments and let's say all kinds of other working capital expenses, or you go to the route that you take the entire factory as a starting point for the use of proceeds. If you take the entire factory, then it would mean that you look not just at the green equipment in the factory, but all the costs of the factory as a whole. So including not only including the equipment, but also the buildings, maybe even the roads to the buildings. And possibly also the consultant who helped to make the building. So the entire capex of this building. Of course, the manufacturer or the company must then assure that the factory as a whole meets certain climate standards in terms of waste, energy use, water use, etc. The last category is the project expenses that increase food security and resilience. That would be typically, let's say, smaller investments in better plant management, forest management, etc. There are two examples of that. For example, drought and heat-resistant crops. And second, sustainable farm inputs like fertilizers with a delayed release structure or biological crop protection. So then you would already move to, let's say, companies who are in the supply chain, but who are not food and agri companies themselves, but who produce something for these companies. Another example would be the drip irrigation companies. Second, what you see, of course, in the soft commodity traders, they have, of course, a lot of efforts in responsible supply chains and food security, but also in, let's say, land assets. And when it comes to food security, in their case, microfinance and input supply finance is very important. So I think that could also be part of a climate bond. Last but not least, all kinds of investments in information technology and information management systems and precision agriculture technologies. I've seen large farmers in Brazil who have large rooms with all kinds of equipment, computers, GPS systems to monitor, for example, fertilizer use across a very large area. We must, however, realize that such amounts are usually not very high when you compare it to the green bond market. So the biggest challenge, I think, is to use either entire factories and the capital expenses for these factories for the green bond, or sustainably produced products, and then all the expenses that can be used for these that are used to produce these products, including R&D, etc. What I didn't discuss is the green securitization part. You could also, of course, look at sales receivables of sustainable products and put that in a green securitization. So that would be the other way around. The company produces them, sells them, and gets receivables from it, and you can securitize that and put it in an ABS. That would, I think, be also a potential way to make this attractive for investors. I think this was it. So we could go to the questions if you like, Justine.
That's great, Hans. Thanks a lot. That was a really nice run through, and some really good advice to those on the line today that could be potential issuers that are looking at this. I think we should definitely turn it over now for Q&A, and while we are waiting to get people up on their audio and raising some hands for questions. Katie, I'll have you kind of keep an eye on that in terms of who would like to ask our first question. But while we wait for those to come in, let me just, so good comments made, Hans, and I think you're right, there are quite a bit of challenges, particularly around scale and getting the portfolio size that's attractive for green bond issuance. So I guess the question is, you know, is there a lot of costs associated with this process? And for issuers, would you encourage them to participate? Essentially, why do this? Hans, we have you on mute.
Sorry, I was on mute indeed. No, the costs are relatively low, I think, for an issuer. The main challenge is for the treasurer that he or she can find the amounts and let's say can identify the amounts. So that's why I said that we must look at the total expenses for products and the total expenses for factories, buildings, and production facilities. So you must realize the treasurer can, let's say, raise 500 million in 3 days when he does a normal bond. When he does a not normal bond but a green bond, then it will take them 3 months. So it must be as easy as possible for a treasurer to do this. And when you then would require from such a person that he would, across his entire company, add up all kinds of small projects and small investments, he or she will not likely not do it. So I think the costs are low, but we must make sure that that it fits in the normal work of a treasurer and the kind of amounts that he already knows from his own reporting.
Okay, great. Thanks for that. We've had a couple of questions coming through, so let me just throw some out there. From Anirban Chatterjee, thank you for your question. I think I'll direct this to you, Tanya. She's asking whether soil carbon accounting is part of the AFOLU standard.
So I think one important thing to note is that we are dealing with many different potential sectors and many different potential geographies. And what exactly gets accounted for depends on what is actually put into the specific bond issuance. However, in things like primary production systems or primary producing assets, we would definitely expect an issuer to include that. And we have made reference in the technical guidance to what we see are some of the most credible approaches and tools and databases for being able to establish baselines and forward projections. So where that is relevant, yes, that is included.
Great, thanks, Tanya. We also have another question coming from Maria Soshinskaya, and my apologies if I've completely butchered your last name, but thank you very much for your question. I think this might be directed towards Hans, so I'll let you have a stab at this first, Hans. So thanks for this breakdown of categories. You mentioned sustainable management of land assets and project expenses to increase regional global food security, and that certifications can be indicators of this. Is there a list of acceptable certifications?
No, there is not a list of acceptable certifications, but I think we must think of the most well-known ones, like Responsible Soil, RSPO, MSC, FSC, that kind of certifications. But also a bit broader. If you look at the retail, you have a lot of food labeling and environmental labeling nowadays. The OECD has a nice team that studies all these so-called ELIs, environmental labeling and information systems. They have produced very good, let's say, overviews and research documents for this. And there are a lot of providers who produce databases of these certifications. Via the OECD, you can also find these. So I think at the moment the climate bond standard is still very flexible and open to suggestions from issuers. I think the most important thing is that standards are credible, externally verified, that kind of criteria. But the OECD has a perfect breakdown of such certifications and the criteria.
Tanya, would you like to add to that?
No, I think that's fine.
Okay. We've also got another question coming from Juan Chang. Climate funds like the GCF are able to finance at project upfront investments and at result-based payments measured in TCO2. What role do you see the GCF in climate bonds for AFOLU? Well, what I can go ahead and just take a stab at that, because in fact we have been speaking with much of the secretariat that's involved with the GCF. Timely, because they are also putting in place, or have already, but it's also in continuous development around the determination of project or at least investment eligibility to be able to access GCF funding. And so what that actually looks like, how they make decisions, the standards program could be seen as just not at AFOLU, but across all different sectors, on being able to inform what they should be looking at in terms of identifying good investment areas globally, particularly in the emerging market. So that decision process is something that the standards could help with. It's also an opportunity for seeing for credit enhancement. So should the projects be qualifying against the standard or certified, that could also be an opportunity to access finance. So there's quite a different bit of discussions being had there. Nothing solidified, but yeah, the conversations are happening. I don't know if any of you guys want to add to that. Tanya, any mention there?
Yeah, I think it's important to note that though the GCF is going to be a very important facility, I think the issue is really how do we scale and how do we encourage very large institutional investors to participate more in sort of the green space and green investments. And while the GCF and their tools are very important, both in terms of their projects and also being able to support things like climate bond issuances and green issuances, I think these standards are trying to sort of reach at a much higher scale in terms of actually trying to mobilize debt capital markets towards green investment. So I think that they're very complementary, but targeting slightly different sort of audiences, if you were.
Great, thanks, Tanya. We've had a couple of questions coming in around the verifier costs, and so let me tackle, there's two related questions here. Let me first tackle Raul de Serra Frazaio's question. Do I understand the business model correctly? Can issuers determine their verification fee by themselves, and that the registration of the bond with this standard is a tenth of a basis point? So essentially close. The issuer decides which verifier they want to go on based on, I would say, from a cost point of view, but also from quality of the service. We put together a long list of different types of verifiers. All of them, of course, are eligible to be able to carry out the verification against the standard. They've gone through a process of application and review by the board on how they become an approved verifier, so that's an important note to make. But essentially what we wanted to do is give issuers the opportunity to engage with the different types of verifiers that we have and make a decision based on that, in hopes that over time, as the verifier body list grows, the cost becomes more competitive. We have already started to see the costs starting to come down compared to what they used to be at the start of this market, so that shift is beginning. But again, the certification did not want to be seen as the cost barrier. So yes, the certification fee, which is essentially the board reviewing and the processing for that, is a 1/10 basis point of the total bond value. And so related to this, Judith Moore has asked a question. You noted that the selection of verifier is often cost-driven on the part of the issuer. The quality of second opinions vary highly, possibly cost-related. Is there a process in place to address this problem? Again, this is not something that we do have control over. The issuer going with a second, let's break it down to where it has nothing to do with the standard and it's going strictly by the second party opinion piece. And an issuer is hunting around for the right costs associated with that and comfortable with the way that they're going to be doing the reporting. And so through that model, you have quite a bit of subjectivity that is taking place. You're having that entity interpreting what the issuer is putting forward and coming out with a result in the form of this opinion. So again, that comes down to the challenges of variability, of disclosure, and the quality of disclosure. And what we have found is that we've either had the same second-party opinion provider do a really great report for one issue and not so great for another. And there's a lot of reasons for that. And so by having the standard piece in there, that removes that subjectivity. All that was being requested from the verifier side is being able to provide the evidence that the standard is requiring that the issuer, and works with the issuer on that. So in terms of the cost, once again, it really comes down to between the issuer and the verifier on determinants of cost. So we don't have any more questions coming through on the chat box.
So there's one other question. I'm not sure if it was sent to the whole group. So it's from Catherine Bryan. And it says, given the complexity of GHG calculations in this sector due to life cycle issues, long-term carbon stores, and the impact of local climate, using a net positive GHG impact may not compensate for different calculation methods, ?
Well, I put that to you, Tanya.
Okay. So obviously this is, as I've mentioned before, this is a hugely complex sector with, as you say, different life cycle impacts and different levels of uncertainties within specific regional data sets, national data sets, and also sectors. I think at this point, what we're trying to move, in recognition of this, what we're trying to move towards is that there at least is some level of consistency and consistency in the type of scientific information that's used and where that comes from, and transparency over what is used to do those calculations. And also in terms of some of the methods. So, you know, we've referenced some of the main soil methods like the co-farm tool, exact, DNDS, and we would expect to see reference to those because at the moment we're not seeing very much consistency and transparency in that kind of information base. There was some discussion around to what extent we should maybe allow for net emissions in the case where there was a very strong adaptation or resilience argument. However, I think the state of the science around adaptation and resilience and the impact of those is at a much earlier stage, and I think it may happen in the future. However, I think at this point we just wanted to make sure that there was at least a credible basis for saying there was a net positive greenhouse gas impact. So no, it's not perfect, and we recognize that definitely, but it's a starting point. And it's a starting point that hopefully encourages transparency and consistency in use of existing best scientific information and methods.
Great, thank you, Tanya. I'm conscious of the time. We've now drawn upon the hour. We do not have any other questions coming through. Let me quickly check with Katie. Do we have any coming through, Katie? Sorry, Katie, I can't hear you. You're not coming in clearly, Katie, sorry.
I don't have any more questions.
Okay, sorry, Katie, thank you. All right, so we'll draw this to a close. Let me first by thanking our guests today, in particular Hans and Tanya. Tanya, our lead specialist, who has done an extraordinary job helping us get to this stage. We are in public consultation. Please do engage, share your thoughts, criticisms, comments. We welcome anything to feed into the public consultation period, which will go until November 6th. So do please submit your comments. You can do this online or via email. Information is found on our website at climatebonds.net. Thank you to Hans. We really appreciate having you here today. You did a fantastic breakdown on your end of opportunities, challenges, of course, but most definitely opportunities and how to get there. So great to have Rabobank represented with this work and the support that you've provided. It's really great to have you involved. So thanks for joining us today. And thank you to everybody who joined us, whether it was an early start for you or a late. It was great to have you, and thank you for the questions. So everyone, have a good day or good evening, and signing off.